Good evening, all. Thank you for joining us. On behalf of Bajaj Finance Limited, I'd like to welcome you all for today's session. Friends, it is a continuous and consistent endeavor to bring latest news and knowledge from the world of mutual funds for our audience and customers, and for which we keep inviting leaders from the mutual fund industry to come and share their expertise and knowledge with us. Today, we have with us Mr. Dhananjay Tikariha, Senior Vice President, Equity Research and Equity Fund Manager from Kotak Mutual Funds. And today, he will talk to us about the NFO of Kotak MNC Fund. Mr. Dhananjay, I'd like to welcome you for today's session.
Thank you, Rohan. Thanks for the opportunity. We always like any opportunity to speak to potential investors and participants in the market. It always allows us to grow as a company, as a investment company. Thank you.
Thank you, sir. We are glad to have you. Friends, before we start off, I'd like to give a brief introduction about Mr. Dhananjay. Mr. Dhananjay is a seasoned investment professional with an extensive experience of around 14 years. He has been with Kotak Mahindra AMC since March 2008. By qualification, he's a BTech from IIT Madras and an MBA from IM Lucknow. Friends, before we begin and for a better understanding of our audience, I'd like to briefly explain the term NFO. Friends, what is NFO? NFO stands for New Fund Offer. It is the initial sale of mutual fund scheme issued by any fund house for its investors. This NFO allows the fund house to accumulate the initial corpus so that the fund manager can build a portfolio based on the investment objective of the scheme. Fund house generally offers a subscription period of around 10 to 15 days, which is called the NFO period. Friends, today we have in hand the MNC fund, and I'd like to quickly talk about what are MNC funds. फ्रेंड्स हमने बहुत बार सुना होगा हमारे गुप्ता जी का बेटा एमएनसी में जॉब करता है, बट कभी हमने अपने इन्वेस्टमेंट्स को एमएनसी बनाने का सोचा है? फ्रेंड्स, एमएनसी फंड्स होते क्या है? एज द नेम सजेस्ट, they are equity themed funds which are investing in stocks of multinational companies operating in the country. They aim to leverage the growth potential and global expertise and strong governance of MNCs and are not sector specific. They could be across different sectors. And friends, in today's session, Mr. Dhananjay will talk to us about Kotak MNC Fund and its feature and how it can become a very good part of any investor's portfolio. So, without wasting much time, I'd like to hand over the stage to Mr. Dhananjay. Sir, please kindly take it ahead from here.
Thank you, Rohan. So friends, as Rohan said, that this fund which we are talking about is a thematic fund which will invest in MNC companies. Now, why we have chosen this theme? The basic idea behind this theme is that we want to select quality stocks for our portfolio. Now, what do we mean by quality stocks? So, the basic characteristic of a quality stock is that it grows. The growth in the stock is, say, decent, is similar to the market, but the visibility of growth is much higher. The confidence of on growth is much higher. So that is the key characteristic of quality stock, and what we believe and what we will look through in the presentation is basically MNC theme allows you to select quality stocks for your portfolio. And if and what our belief is that if you have a set of quality stocks at this time in your portfolio, it will give you much basically it will give you the desired growth in your portfolio along with the protection if the markets are not doing that well going forward. So basically it allows you to participate in the growth but also have more higher protection when markets are not expected to do so well. So that is the basic idea of the MNC thematic. Now, if we can go to the second slide, please. So basically, what is an MNC? So the how do we define an MNC? So
Just a moment. Let
yeah,
us make the
sure.
PPT live. Okay. Yeah. Second.
Yeah.
Yes. Yes.
So basically, what is an MNC? So MNC is basically a company which is promoted by a foreign company, and it is listed in India. So that is the first definition. The second definition, what we have added, is basically Indian companies with more than 50% of revenues coming from overseas markets. So basically, why we have added the second definition is because it allows us a wider universe to invest in, and also allows us more sectors to invest in, and a wider sectoral coverage of the universe. So basically, overall, if we add both Indian companies which are going to various other countries, and also foreign companies which have come to India for business. So if we combine both, we are able to build a good portfolio which can give you growth as well as protection. So that is the basic idea behind selecting both these definitions for MNC. Now, next slide. Now, when you look at basically why an MNC should be a quality company, that is the basic argument. So basically, if a company is operating into number of countries and successfully, then it must have products which are desired across geographies. So the products would be world class. Second is the brand would be strong, that there is demand for these brand across countries. So basically, you would have strong brand recognition. Also, you would have management which can deal with the challenges which come through operating in various which come through operating in various geographies. So these management should be capable enough to deal with such challenges, and company should have financial stability so that it can right through the business cycles which come in various countries. And basically, when we look at when companies operate in many countries, each of the countries have their own challenges in terms of business cycles. Some countries would have challenges related to exchange rate. Some companies would have challenges related to supply chain disruption. So companies should be financially strong to weather through these issues. So if a MNC company is strong enough, is doing good enough, then it will have all these four strong characteristics. And it is very natural that if a company has these four strong characteristics, it is going to do much better than the wider universe. If a company has good products, company has ability to sell those products. If the company has strong management and also financial stability, so it is very very likely that the company will do much better than the wider investable universe. So this becomes a key argument that we are looking at MNC theme, and MNC theme will give us companies with these characteristics, and these characteristics are vital, which allow companies to do much better than the peers. And hence we think that this is a good theme to invest in. Yeah. Next slide. So we will go through all the four characteristics which we have enumerated, and look at how these strengths actually help companies create better value for shareholders. So yeah, next slide, please. So when we look at brand, so basically, one small trivia is basically 9 out of 10 most known Indian household brands are basically HUL brands, and HUL is a MNC. Though it has been present in India since many decades, it is a foreign company, and it has been able to build such strong brands. So that just shows us what is the depth of depth of the strength which these companies have been able to create. Next slide. Also the names of the companies which we have shown in this slide. So all of these companies are MNC companies, and all of us are very familiar with these names, and these companies are leaders in their respective sectors, and basically their products in terms of their brand is so strong that basically the brand itself is an indicator of quality of these products. So this is a slide just as a kind of a visual aid to see how MNCs have been able to build very strong brands across sectors. Next slide, please. Now, why MNCs have been able to build such strong brands is because they continue to invest. They continuously invest higher than their domestic peers in branding. And as you have seen the chart, this is last 11 years chart. MNC companies have continuously invested higher than their peers in branding. To this allows them to have higher market share, charge higher premium in terms of pricing, and this allows them to actually have higher profits. And with their higher profits, they continuously are able to invest higher. So it becomes a virtuous cycle. Next slide, please. So this is a case study which we have shown as to how with the help of a very strong brand, Maruti Suzuki, which is an MNC, has been able to maintain its very dominant share in entry level passenger car market. So currently, Maruti's share is, this is on the overall passenger car market, is 41%, and this is despite multiple competitors coming in through, say, Korean companies have come in, Japanese companies have come in, European companies have come in, American companies have come in. So all companies have tried to take share away from Maruti but have failed so far. So this shows the strength of a brand, what it can do for a company over long periods of time. And obviously shareholders have benefited immensely from from participating in the growth of this company. Next slide, please. So on similarly, similar to brand is a strength in terms of strong products, and strong products come from basically cutting edge technology and continuously significant R&D expenditure. So next slide, please. So basically, MNC companies are able to get technology from their parents, and so basically, for example, Siemens India gets the technology from Siemens Limited, which is basically the parent in Germany. And and basically, since Siemens AG, the parent in Germany, is able to pool all the resources across the group and invest that into R&D, the overall amount of R&D spend which the group can do is much higher than any company which will operate in only one country. So since the overall revenue base is much higher, their ability to spend in R&D is also much higher, and this allows continuously higher R&D, and basically the products which are generated from this R&D are continuously better, and over a period of time their competitive advantage continues to improve. So next slide. So here we have shown an example through example as to how continuous spend in high R&D helps companies survive and thrive. So basically, just an example, Cummins manufactures. We all know Cummins is a leading brand in diesel engines. They are world's leading manufacturer of diesel engine. Now this is diesel engines are basically directly linked with fossil fuel economy, and now there is focus on transitioning to carbon neutral products. So there is So it is imperative that in next few decades, diesel engines will not be there in usage. It will have to be replaced. So Cummins, through its R&D, has now already developed products which will replace diesel engines. So they have already manufactured products which will take green fuels, like green hydrogen, green ammonia. They have already developed products like electrolyzers for manufacturing, for producing green hydrogen. And they have already developed fuel cells that will use green hydrogen to generate power. So they have already developed products which will fit into the new green hydrogen economy. So Cummins, rather than rather than becoming obsolete as a company, because of this shift towards green products, actually is now able to use that as a opportunity to grow, because of its R&D strength. Whereas you will see that a lot of Indian companies, Indian competitors of Cummins, who manufacture diesel engines but who do not have resources to invest in developing these products, will struggle going forward. Similarly, Bosch. So Bosch basically is a leading is the manufacturer which manufactures injectors for diesel engines, fuel injectors for diesel engines. So and this Bosch also, the company also is very closely linked to fossil fuel economy, basically, because their key product is a component which goes into diesel engines. But they have also now developed components uh, for EVs, and basically and they should also remain relevant going forward, despite diesel engines becoming obsolete in the medium to long term. Yeah, next slide, please. Yeah. So also in the third strength, MNCs have much better management quality, and also very strong financial stability. So we will see as an example in the next slide, where just one company, which is HUL, basically next slide, please. So four top managers, four key management personnel from HLL basically have come out and are now leading four companies in India, which are very well renowned in their own sectors, as CEOs. So this shows the strength, the depth of talent, managerial talent, just one MNC company has. So this is an indicative of the difference in the quality of management across, compared of MNC companies compared to the domestic counterparts. As Rohan also said in the opening remarks, that working in an MNC is a kind of still considered as a very privileged opportunity, and that is because that allows any person to grow and become more capable, and basically rise up in their careers. Next slide, please. Yeah, next slide. We've discussed this. Uh, Huh. So basically, this is also a case study where we have explained how a change in management from a usual management to a very capable management has created value for shareholders. So JB Chemicals was a company which was run by the promoters, a pharma company run by promoters, and it is a very old company, and it had been growing at a moderate growth uh, till FY20, when it was acquired by KKR, and KKR is a private equity firm, and KKR replaced the management with the management which was mainly from other MNC companies. And basically these and the new management was able to basically turn around the growth and also the profitability of the company, and this has led to sharp improvement in the stock price of the company, and this has created a significant value for the shareholders. Next slide. In the next slide, what we have shown is basically the significant significantly lower debt to equity ratio of MNC companies. This shows that they are financially more stable and very less vulnerable to any financial shocks. So basically, if your debt to equity ratio is lower, your ability to kind of invest for growth, or basically to deal with any kind of disruption in business is much higher, because your fixed cost, which is there in the P&L of interest, is much lower relative to your revenues. So hence, a lower debt equity ratio is a very positive sign for financial stability. And MNC companies have continuously, or say over long term, have maintained lower debt equity ratio compared to their domestic counterparts. Yeah. Next slide, please. Yeah. Now, basically, in this slide, what we have shown is the number of sectors in which MNCs have dominant position. So, if we look at overall number of sectors, so AMFI classifies the entire listed universe in 22 sectors, and out of these 22 sectors, in 10 sectors, MNC companies are in top three position, in one of the top three positions. So this shows the significant presence and dominant presence which MNC companies have in India. Next slide, please. Yeah. So basically, now why do we think that MNCs would continue to do better fundamentally going forward as well? So they have done well in the past. If you look at the performance of these companies, so why do we think that they will continue to do better going forward? So next slide, please. So basically, what we think is India is going through a structural growth phase where both consumption as well as investment is doing well, and Indian per capita GDP is crossing a threshold of $2,000 per capita. So what we have seen in other countries is that when we cross that, there is a significant increase in ability of the overall people to spend in newer products, in newer services for consumption, and this will drive the structural growth in Indian market going forward. So what we saw in previous slides is that MNC companies are dominant in multiple sectors, and if India as an economy is going through a structural growth phase, then these dominant companies are bound to grow much better going forward. So basically, this is the key point in terms of what gives us confidence that MNCs will continue to do. So these are dominant companies in their sectors, and India as a market is going through structural growth phase. Hence, these companies would continue to grow in the foreseeable future. Next slide, please. Yeah. Next slide, please. Yeah. So also next slide. So this is also next slide, please. Yeah. Also, so MNCs in addition to the structural growth story we are going through, there are a couple of more tailwinds which are helping the growth in MNC companies. One is that as the Indian operations continue to grow, since India is now the fastest growing major economy in the world, the focus of the parents of these companies is now much higher towards the Indian entities, because they want their Indian entities to participate in this high growth market. And what we have seen as a result, as a simple indicator of how the importance of these Indian entities have grown, is basically how how the market cap of Indian listed MNCs has grown in comparison to their promoters market cap. So basically, what we have seen is over last 10 years, the proportion of market cap of Indian entities compared to their parents has actually increased 3 to 4 times in just a span of 10 years. So this shows and this is forcing the parents to focus more on growth of their Indian entities. So this is one tailwind which will help to basically improve the growth which these companies will have going forward. Next slide, please. Also, the China plus one theme, which is ongoing, will also help, because now that the world is looking to diversify their supply chain away from China, India becomes a natural choice. Specifically, when a company is present both in India as well as in China, it is very natural for them to, if they are shifting their business away from China, to shift it to India, because India is the only country which can allow them that scale and that cost which China allows. Yeah. Next slide, please. Yeah. So we have given just a kind of a indicator as to how MNC companies have improved, basically compared to, in terms of has have improved their competition contribution to their overall parents revenue. So Schaeffler, which is a subsidiary of Schaeffler AG, so their contribution to the overall revenue of Schaeffler AG has grown from 4% to 5.5%. That looks small, but overall growth is 40% within 4 or 5 years. Similarly, the localization basically is a representative of the investment that has been done in the Indian company. The manufacturing ability of the Indian company has improved from less than 70% to almost as 80% in last 5 6 years. Yeah. Next slide, please. Next slide, please. So yeah, now why MNCs? What now we will discuss as how this theme has done in the past comparatively as an investment. So next slide, please. So basically, when we look at the returns which MNC index has given over last 15 years, compared to Nifty 50. So we see that it has outperformed Nifty 50 by almost about 300 basis points on a CAGR basis. So this is a very so if you remain invested for a significant time, which is always advisable, then this 3% difference would amount to a significant additional value creation for the investor. And next slide, please. And you would also notice in this slide that this outperformance has come at a lower volatility. So why this is important is basically lower volatility is important because that indicates that your investment has relative to say Nifty 50, the 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 movements, the shock movements both up and down have been lower compared to Nifty 50. So basically what it means is that during the phase of investment, while the shareholder was invested, the shocks in terms of sharp market movements in stock price has been lower. So basically Nifty MNC index has given a more kind of a gradual return over the investment base compared to either Nifty or Nifty 500. So basically, this again reiterates or basically corroborates our thesis that Nifty MNC should give you a quality portfolio, or basically MNC theme should give you a quality portfolio which will give you decent growth, but with lower downside when the market does not do well. Yeah. Next slide, please. So again, we have shown us the similar data through a different similar argument through a different data set, as to whenever in the market has not done well in a significant stretch of time, in that period, Nifty MNC index has outperformed the Nifty 50. Basically, the negative movement in MNC stocks has been lower than the negative movement in Nifty 50. So that shows that if there is a correction in the market, these stocks are corrected much lesser. Yeah. Next slide, please. Yeah. Now this is a slightly important slide as to why. So one question which always comes is that MNC companies always trade at a much higher valuation compared to the say either Nifty 50 or any other similar index. So why should we invest in that? Because they are more expensive. So what we want to say here is basically the valuation has always been higher at a premium of MNC company. The MNC company's valuation has always been at a premium. And if you look at last 10 years average, uh, then overall the valuation of the P 1 year forward P of Nifty MNC is about 36, whereas currently it is trading below that number at around 30 to 33. So basically, we are investing at a point where Nifty MNC PE is actually lower than their 10-year average PE valuation. Also, the premium or the premium over last 10-year average Nifty PE actually is also is about twice. So basically, if you look at last 10 years average, Nifty MNC PE has been double of Nifty 50 PE. Whereas if you look at current valuation, the current scenario, the valuation premium is only about 1.5, 1.6 times. So instead of the double of the valuation, which is the last 10 years average, the current premium is only about 50 to 60%. So what we want to say about this is we are not investing at a point where the premium or the valuation of Nifty MNC companies is at a all-time high and would contract going forward. What we want to say that is it is actually below the average of last 10 years. So it is not at a point where the valuation is very high. Yeah. Next slide, please. Next slide, please. Yeah. Next slide, please. You can skip this slide. Yeah. So where we as active fund managers will add value to this theme. So obviously, we know that there are also ETFs of Nifty MNC available. So how will we, as active fund managers, how do we plan to kind of give better return than actually the passive ETF? So basically, next slide, please. So there are scenarios in which the interest of the management of any say MNC company does not coincide with the interest of the shareholder. Next slide, please. So for example, royalty. So basically, MNC companies pay royalty to their parents for basically access to technology, access to brand, access to managerial skill, managerial support, and sometimes the royalty is much higher than what is justified. In that case, basically the profitability of the Indian entity suffers at the cost of the profitability of the parent. And yeah, and also there's over a period of time, if this continues over a period of time, the stock will not do as well as, yeah, as well as the competition, as well as the peers. So what we will look to do is avoid such scenarios and similar scenarios where the interest of the shareholders has not been kept in mind. And with that, what we feel is that we should be able to avoid some of the MNC companies which will not give good returns going forward. And basically, as a result, our portfolio should do better than just the index. Yeah, next slide, please. Yeah, so these are the scenarios where the interest of the management does not, or the parent does not coincide with the interest of the minority shareholders, like royalty payments we discussed. Similarly, related party transactions, where basically the interest of the parent has been taken care of, but the interest of the local entity, the Indian entity, has not been kept in mind. So basically, we would work to basically avoid such kind of scenarios in the companies we invest. Yeah. Next slide, please. Yeah, next slide, please. So basically, this is the final slide where basically this shows how we will basically invest, and how we will invest in this theme. So first point is basically we will define the entire investable universe, and we will define it by using the two criteria which we discussed in the first slide, which was one, selecting the companies with the foreign parent, and second, selecting Indian companies with more than 50% of sales coming from overseas markets. So currently, the investment universe which we have identified is about 150 stocks. From this 150 stocks, we will select a portfolio of about 40 to 50 stocks, which will be market cap and sector agnostic. So we will not be looking for a market cap bias or for a sector bias. We would go for bottom up stock selection, and we will select stocks on the basis of combination of their growth and their valuation. So we will not be just maximizing growth, so that we will not be just selecting the 40 best, the 40 stocks with the best growth. What we will be selecting is 40 stocks with the best growth to their valuation combination. So we will be looking at stocks with decent growth, but their valuations where the valuations are still not extreme, and valuations are still reasonable. So that is how we will invest in terms of day to day in the theme. Yeah. So that is all from our side. Happy to take if there are any questions. Thank you, Ron.
Thank you, sir, for such an insightful session. I'll open up and ask my audience if they have any questions, they can ask, comment, and Dhananjay sir will be more than happy to answer all the queries. Meanwhile, sir, I have a question for you. Um,
Hmm.
Considering it as a MNC fund, and and should we, as an investor, there are recent and ongoing global geopolitical tensions which are going on, like the Ukraine,
Hmm.
the Middle East, and also the upcoming US presidential,
Hmm.
elections coming up. So, and markets, see and as we are not, sector specific, there are a lot
Hmm.
of global companies which are currently facing challenges of their supply chains and how to manage
Hmm.
that. And
Hmm.
market is supposed to, react in a certain way depending on the elections or whatever happens in the US. So
Hmm.
as an investor, how should I take into account that while choosing this fund, and how are you as the fund manager going to take care of these upcoming
Right.
situations in the world?
So when we look at all these scenarios, basically when we look at the universe which we have identified, so basically for most of the companies, the core market is still India. Only for a small set of companies which will have more than 50% of their revenues coming from overseas are basically will be impacted significantly from the disruptions which happen overseas. So, any disruption which is happening overseas will impact only a part of the portfolio, not the entire portfolio. That is the first point. Second is, if you look at how these events have impacted the Indian market, is basically it's not always it is negative. Basically, it also gives opportunities. So, because of the war in Ukraine, what we have seen is a number of countries are kind of looking at alternate supply chains. So they are giving orders to Indian companies to basically have more options in case the war escalates, or in case the war expands to other geographies, so that India being seen as a country which is favored by almost all countries. So there are very few countries which are enemies to India. So basically, global companies are looking at India as a safer option for sourcing, and actually, this war has helped in that. This war has kind of empowered that notion further. So in the medium to long term, there have been opportunities also. In the short term, there may be problems because that may kind of lead to spike in oil prices, or basically disruption in for some time in the supply chain, by as we've seen, because of Israel Iran war, Suez Canal traffic
Suez Canal, yes.
was kind of stuck. So but that is a scenario for a small period of time. Then basically, when companies look at alternate options and all, basically India kind of stands out. So actually, for the medium to long term, so far it has been in favor. So what we think is that as long as oil price is in normal range, normal by me say it is lower than $90, then overall India will continue to do fine. So that is, and obviously we as fundamental investors will uh, continue to look at each company very closely and find out if there are any negative if there negative impact of these events on these companies, and actually look at and actually find out and select those companies which are able to use this as an opportunity to grow. So that obviously is a continuous endeavor on our part.
Fine, sir. Sir, I have one more question for you. I am not seeing any questions from the audience.
Hmm.
So, what should be the ideal investment horizon that a customer should look at while investing in this fund? And also, at the same time, what is the ideal mode for them to invest?
So sorry, I missed the last point.
Mode of
Ideal
investment. How should they
mode of
plan to invest? Mode.
Okay. So basically, what we are suggesting is at least an investment horizon of preferably 5 years. Basically, because so this is a thematic investment. So thematic investment needs some time to actually show the power of that theme. So basically, desirable would be 5 years horizon, and basically, if you are kind of inclined to stay for 5 years, then you can start with a lump sum investment as well, because that 5 years is a good duration, which will kind of cover any for risk which kind of you take by investing in lump sum. So for 5 years is a good enough time where any kind of say a timing issue which will get addressed. In terms of an SIP also, basically a scheduled SIP, or as the or basically a STP, over say 6 to 12 months also is fine. But also in terms of but the bottom line is for the theme to work, you need to give it say 5 years or so
Right.
to see the fruits of these themes.
Okay. Thank you so much, sir. I do not have any questions, and I believe audience is also not having any questions. But my friends, I know if you are busy and you have saved this particular event to watch later, feel free to comment, and our team will get back to you with the right answers to help you make the right decisions. Before I end the session, I want to wish all the investors to please take care of their investments. Also, be part of the investor education initiatives that we keep taking part and keep bringing to you. Also, this video will definitely, as explained by Mr. Dhananjay sir, will help you make the right choice, understand the different features and the objectives of this particular fund. We at Bajaj want to become the part of your investment journey and help you create wealth for yourself. So please feel free to get in touch with us, and by commenting in the comment section. We are available both on live currently on both on Facebook and YouTube. Before we end the session, sir, Dhananjay sir, any few words you want to share with the audience?
So, what I want to say is that basically India opportunity remains strong. You need to be a disciplined investor and basically an investor over long period to take advantage of this opportunity which we are seeing. So as Rohan said, keep yourself aware, keep yourself updated, and invest with the discipline in the market. And if you remain invested in the market for long and through discipline, you will definitely make good returns.
Correct.
Thank you.
And we want to partner in that growth journey, investing and creating wealth for our investors, and we want to be your partner in that particular journey. So please, you can feel free to visit our website. Also, please download our Bajaj Finserv app. You can explore the mutual fund section over there. We have the NFO section where this particular NFO is live. You can rewatch this video again, learn, and then make the adequate decision. I hope this session has provided with all the basic requirements and the knowledge that you need to decide to choose this particular fund. Thank you, friends, for joining us. Thank you, Dhananjay sir, and I would like to wish Kotak Mutual Fund all the best for this particular NFO and the coming ones. Uh, we're
Thank you,
looking
Rohan.
forward.
Thank you.
We'll be
Thank
looking
you.
forward to do more such sessions with you and with Kotak Mutual Fund. Thank you, everyone. Thank you, sir. Thank you for joining us.
Thank you.